Welcome back to the Success Blueprint Investment Edition. Ethereum, Tesla, MicroStrategy, Palantir, Robinhood. What do they all have in common? They've been misunderstood, written off, and are now leading a quiet revolution. In today's video, we're diving deep into 3 high-conviction investment ideas. 1. Why Ethereum's real breakthrough isn't NFTs or DeFi ecosystem, but stablecoins and dollarization. 2. How crypto treasury companies are quietly becoming some of the most powerful players in digital assets. 3. And why certain washed-out stocks like Tesla, Palantir, and Robinhood are worth a second look, even as the headlines stay negative. We'll also challenge some myths about retail investors and look at why institutional pessimism may be the ultimate fuel for this next leg up. Let's break it down. Ethereum isn't just a cryptocurrency, it's a programmable blockchain, the infrastructure layer of the future internet. And while NFTs may have faded, Ethereum's new killer app has quietly taken over stablecoins. 80% of stablecoin usage is happening outside the United States, fueling global dollarization. Think of stablecoins as the ChatGPT of crypto. They've broken into the mainstream. With US Treasury support and projections of a $2 trillion stablecoin market, Ethereum stands to benefit from explosive growth in gas fees. Gas fees on Ethereum are the transaction fees required to use the Ethereum blockchain, including when transferring stablecoins. These fees, paid in Ether, ETH, compensate validators for processing and validating transactions on the network. Gas fees are not specific to stablecoins. They apply to all types of transactions on Ethereum. Ethereum is now the bridge between Wall Street and Web3. Companies like Robinhood are using Ethereum Layer 2s to tokenize equities. In 2021, ETH was all about NFTs. In 2025, it's about programmable dollars. While exchange-traded funds lose value through fees, treasury companies like MicroStrategy or Ethereum-centric firms aim to grow tokens per share. They're not just buying crypto, they're actually building operating companies around it. Here's the kicker. They can issue stock at premiums to net asset value, borrow at low rates, and even sell volatility to finance growth. This reflexive mechanism gives them a capital advantage that traditional funds just can't touch. If these companies hold a massive portion of Ether, they become strategic. Wall Street may one day find it cheaper to buy these companies than to acquire the tokens themselves. That's the hidden sovereign put. Back in April, the market bottomed, but some stocks, Tesla, Palantir, Nvidia, didn't make new lows. They were already sold off, washed out, and from there, they led the recovery. Tesla isn't just a car company, it's a Da Vinci asset. Elon Musk, manufacturing dominance, full self-driving, and now artificial intelligence. Investors aren't just shareholders, they're evangelists. Palantir is the wizard behind Fortune 500 magic. $4 billion in revenue, 800 customers, and 4,000 people. It's lean, powerful, and unlike anything on Wall Street. Robinhood is doing what Charles Schwab did for boomers, but it's doing it faster, slicker, and with crypto in its DNA. It's positioning itself to be, well, the Morgan Stanley of the Gen Z era. Here's what most investors miss. Retail was the only one buying at the April lows, $40 billion of inflows, while institutions were bearish, blinded by politics or rigid mandates. And what happens after a 20% drawdown and new highs? That's not a bear market rally, that's the start of a bull market. Ethereum is evolving, treasury companies are innovating, Tesla, Palantir, and Robinhood are leading. And retail investors? They're no longer dumb money, they're driving this market. These are just ideas and not investment advice. If you found this breakdown helpful, hit like, subscribe, and drop a comment. What's your highest conviction investment in this new cycle? The Success Blueprint Frameworks for Work and Life.